Hey investor friends, I'm Michelle Markey, and today I'm going to share the best high interest accounts and investments for early 2022. And I say early because with inflation hovering at around 7%, that's eating away the purchasing power of our dollars every day. So it's kind of like if we have our money just in a very low yield savings account, we are losing a lot of money to the dumpster fire known as inflation. So we know that the Federal Reserve is going to want to control inflation and bring it down closer to their 2% target. But I'm going to be honest with you, pickings are slim if you want to get really high interest types of accounts that can truly combat the effects of inflation. But later in the year, if the Fed raises interest rates or their benchmark rate known as the Fed funds rate, that's also going to influence banks to raise their interest rates. So most likely you'll be seeing savings, money market accounts, and checking accounts with better yields the later in 2022 we get, and also likely going into 2023 or 2024, as long as the Fed doesn't have to lower interest rates again if they start raising them for a while. So if you're also always on the lookout for yield like I am, I'd love if you could please like and subscribe to my video and YouTube channel, because that's what I'm here to do, is to try to help us out and try to find some yield so we offset some of the effects of inflation. And also, I'm not a financial advisor and I'm also not sponsored. So all of this is just from me doing some research online, and I'm trying to find what makes sense and is reasonable, and I'll share what I would do, which kinds of accounts or investments I would go for, and I hope this helps you for education and entertainment purposes only. Let's start off with lower yielding accounts and then work our way up to higher yielding assets as we progress through the video. And first, starting off with savings accounts / money market accounts and also checking accounts. If we look at this area as a whole, if you're like a lot of people and have a brick and mortar account, more than likely you're getting 0.01% in interest, which means if you have $10,000 in this kind of account, you're only seeing $1 in the course of a whole year from that kind of account. So if that makes you feel frustrated and you're tired of just getting such low amounts of interest, which means you're still losing 6.99% to inflation if you just leave your money in that kind of typical account, then you might want to consider a high yield savings or money market account that are usually in online banks. So oftentimes a lot of brick and mortar banks don't offer the kinds of yields that we're seeing right now, which are in the range of 0.5 to 0.6 or even up to 0.7%. But make sure you look at the fine print across each and every one of these types of offerings and check out what are their fees or minimums that you need to have in order to open that kind of account. And if you're interested, feel free to check out one of my previous videos on covering both bank checking and savings accounts, which I thought were the best deals at the time. And a lot of the interest rates I covered back then are still relevant now in early 2022. So feel free to look at that for more information. And in general, what I've seen is that this is going to stay like this until the Federal Reserve raises their Fed funds rate, and then banks will also raise their interest rates. But for now, the best account that I've seen across any checking or savings account would actually be from T-Mobile Money, and they offer a whopping 4% and up to $3,000 for eligible T-Mobile customers. So I know that might only be a select amount of people, but if you're one of those people, you could be getting up to $120 a year if you take advantage and only have $3,000 in the T-Mobile Money account, and then you're getting that 4% interest if you meet some of their criteria, and that's a pretty decent deal. And if you're not a T-Mobile cell phone customer, you could still get 1% interest from them, and that's still a pretty good deal. So let's say you are a T-Mobile cell phone customer and you put $10,000 in the T-Mobile Money account. Over the course of a year, you'll get $190, which if you divide that in 12 months, that gets you about $15.83, which I think is way better than nothing, and certainly definitely better than a lot of brick and mortar types of accounts. So keep this in mind. If you want to get better than average kinds of return on just a simple checking account with not really strings attached, and it looks like it's pretty liquid and it's FDIC insured, which means that the federal government is backing accounts that have up to $250,000. So it's pretty safe, and you're likely to get your money back if there was ever a bank run, and you'll be totally fine if you put your money in accounts that offer FDIC insurance. And with certificates of deposits or CDs, This is where you basically agree with your bank to give them a short to medium term loan in exchange for a fixed percentage interest amount. So then you'll be committing for a certain term, which is a few months to several years, and then you'll be getting a fixed interest rate over the course of the CD's life. And then with this kind of thing, you're getting interest rates that are comparable to high yield savings and also the checking account with T-Mobile, like I mentioned. And the 5-year CD has rates that are not even competitive with the 5-year US Treasury bond right now at around 1.5%. So in my opinion, CDs are not yielding high enough of an interest rate to make them worth it. And then in addition, a complex instrument called Annuities can offer interest rates in the form of 2 to 3% right now, but they can also be in the course of several years to at least a lot of years, like 10 years or more. And I feel like this is a little bit complicated, and annuities are something that you really have to study carefully, but they could be right for you if you're the kind of person who likes the idea of secure payments over the course of time. And they work kind of like an insurance policy where you pay into the annuity and then you get certain periodic payouts at certain points of time. So make sure you look into that kind of thing if that would be of interest to you. And with US Treasury bonds or bills, these are the US government's debt, so you're basically loaning the US government money when you decide to purchase any US Treasury bonds or bills or notes. And then the 5-year Treasury bond, like I mentioned earlier, is 1.5%, and then the 10-year Treasury bond is at 1.76%, and then the 20-year Treasury bond is at 2.15% at the time of recording. And all of these rates are pretty mediocre, so I don't know why a lot of people would want to go for these kinds of things that don't seem to yield a lot, and you're locking up your money for a good amount of time. And if interest rates go up, then the value of the bond you're holding now at lower interest rates are not going to be as valuable. So for a lot of young people, I wouldn't go for bonds because they're just not yielding enough. And with money market funds that are in brokerage accounts, these are not to be confused with money market savings accounts that are usually in bank accounts. So with money market funds, you can get these in a lot of typical brokerage accounts, or you may have them as an option in your 401k. And they usually have pretty low interest rate yields of something like 0.01%. But you should be careful about these because they have expense ratios, which can sometimes be in the amounts of 0.09% to 0.13%. So you're actually losing money actively by putting money into a money market funds account in a brokerage account. So this is different than having it in a money market savings account where they're both liquid, but when it's a savings account version, you can have that money still generating some positive amounts of interest, and you usually don't have to pay any fees for getting that kind of interest, unlike the version that's in your brokerage account. So just pay attention to that. For more than a decade, the stock market has been the main place to be if you wanted to outrun the effects of inflation, and you did way better than if you owned bonds over the last decade. But right now, the odds of the stock market continuing to give generous amounts of return seem to be decreasing. So I would be careful going into 2022 with the stock market, but still continue to invest in stocks if you find a good deal, especially if stocks are on sale, because I'd be careful about paying for stocks with incredibly high valuations, as the Shiller PE recently showed that the overall S&P 500 had been as high as at 40 PE, which means that forward projected yields could be as low as on average 2.5% based on that kind of measure, because the historical stock market average rates of return were closer to when stocks had a PE of around 15, which meant that stocks would provide a 6.7% rate of return, which used to be the average amount. So usually when people say the stock market's average rate of return is between 7 to 10%, that's where they're getting it from, when the stock market PEs are usually in the lower range, like around 15 or less. And nowadays, with PEs being pretty high, that can be a little bit concerning. So it's not surprising that a lot of Wall Street is estimating that returns for 2022 could be around 4% on average, and some are more optimistic or bearish than that. But you could see, based on the overall that expected rates will be kind of mediocre for 2022 after the glorious years that we've had in 2019, 2020, and 2021 with rates of return in the S&P 500 yielding in the high teens and the high 20% range. So that was pretty lucky, but I wouldn't count your stars on continuing to be so lucky in the stock market. And overall, if we expect dividend yields to continue being at around 1.5%, that's the best that we can generally hope for. And also, don't believe that there are any safe dividend stocks with high yields, because there's no such thing as a safe stock, because companies are much like how humans grow throughout our biology, and we live our life and we have periods where we grow and then we also have periods where we decline. So that's the same with companies. So no company is ever safe with their dividend, especially if the economy comes upon rough times, like with what happened to Bank of America stock during the Great Recession, where their stock price still has never recovered, but Bank of America still gives a 1.7% dividend. So if you've held on to Bank of America stock, you've gotten some dividends out of them, but you haven't really gained in terms of the stock price. So just be careful with what kinds of dividend stocks or just regular stocks you may be invested in, and whether you expect their dividends to continue remaining strong or not, because they could definitely trim or eliminate their dividend yields if they come upon rough times. And let's say you just want to continue remaining invested in an S&P index fund or ETF. So let's say you might want to invest in the SPY, which is looking like it might get you a dividend yield of 1.23%. And then if Wall Street projections are anywhere near correct, then you're looking at 4% returns in 2022. So overall, that might get you for the year 5.23%. And that would be probably pretty decent. And even though that's not outrunning inflation, it's better than a lot of bond yields and other kinds of assets right now. Real estate investment trusts, or REITs, are companies that usually own and operate income-producing real estate, and they can either be publicly traded like ordinary stocks are, or they're not publicly traded. And in general, they're required to give most of their profits and dividends to their shareholders, so they actually have above average rates of dividends. Like if you have equity REITs, which own properties, that tends to get you on average 5% in dividends, whereas those that own mortgages or mortgage-backed securities can get you rates as high as 10% on average. So even though that seems pretty generous, you should also pay attention to whatever kinds of risks that there may be in owning REITs, such as liquidity limitations, like if you can't get out of the stock or shares that you own of REITs, and then also if there are fees, and also if there's interest rate risks, like if the interest rate starts going up, then that can negatively affect publicly traded REITs, because then investment dollars will want to go into other kinds of assets, especially if interest rates make mortgages more expensive. And then maybe that's not as attractive for real estate in general, because the higher the interest rates, the lower the prices in real estate might be. So that could potentially impact the prices of REITs in the future. And then also there may be tax implications. So just pay attention to a number of these kinds of considerations before you might want to invest in a REIT. Like U.S. Treasury bonds, U.S. savings bonds are where you're loaning money to the U.S. government in exchange for interest payments, and they're also backed by the full faith and credit of the United States government. But what separates the U.S. savings bond from U.S. Treasury bonds is that you can buy them in increments as low as $25, and so that could be great if you want to give these things as a gift to someone. And with U.S. savings bonds, there's the fixed rate version called the Series EE, which is only giving you a 0.1% interest rate. So that's not really ideal. But what could be potentially attractive could be the Series I, which is currently giving a composite rate of 7.12%, which seems surprising. Like that's pretty much the average stock market rate of return, right? So even though it seems attractive, there's actually a little bit of a catch, because that rate on the Series I bond is a variable rate that's tied to the rate of inflation, and it's set every 6 months. So the current composite rate of 7.12% will be in place between November 1, 2021 through April 2022, and then there will be a new rate that's set on May 1st, 2022. So you could potentially benefit for now if you want to lock in some amount of money at 7.12%, but it could change by May 1st and it could go up or down. Nobody really knows how much inflation will be by that point in time. So at best, you're looking at being able to lock in 7.12% for 6 months, and then it could change. And it's a 0% on the fixed rate portion of the Series I. So it will always be 0% for the life of a Series I bond. And in addition, since it's a zero coupon bond, you don't get paid interest payments throughout the life of the bond. You get paid at the end. So just keep this in mind. And they're meant to be held for at least a year, and then you can redeem them. And they're meant to be held for at least 5 years. And if you don't hold them for at least 5 years, then you might lose interest payments of about 3 months. So just keep that also in mind if you're interested in any U.S. savings bonds. If you're curious about preferred stock, these are kind of like quasi-bond stocks where they have qualities like bonds that offer fixed income rates of return, and they also get preferential treatment over common stockholders. Like if a company goes bankrupt, the people who get their money back first are bondholders, followed by preferred stockholders, followed by common stockholders. So hence the name and these kinds of stock names. And then like stocks, preferred stocks are more easily traded like common stocks are compared to bonds, but they also can be converted into common stock. So if you have preferred stock and maybe there's some condition that makes it attractive to want to convert it into the common stock version of a company, then that could be a potentially attractive choice. And in addition, we can see with Bank of America, they have a few preferred stock options, and one of them offers a rate of return of 4.25%. So that seems pretty decent and better than maybe other kinds of bonds. And if we look at some preferred stock ETFs, they seem to have on average a rate of return of 4.5% since inception. So that's kind of looking like the average rates that you would expect with preferred stock kinds of offerings. And then in addition, separately from those things, there's also corporate bonds. And even though these tend to give higher yields than maybe government bonds, like if we go for an ETF, that might give us a rate of 3.3%. And then if you subtract some of the expense ratios, that might get down closer to 3.2%. But in general, this is also a little bit mediocre. So it's not super ideal. And right now, with the most amount of corporate debt that the US has ever had, I think that corporate debt could be a little bit risky, so be careful if you choose to get any bonds that are from corporate debt. To summarize, I put together a little table showing all these kinds of accounts and investment offerings, and also what their nominal rate or face value rate is, and then what the real rate might be if inflation really is at 7%. And then I also put, in my opinion, what I think the liquidity level is, so how quickly you could convert the funds in that kind of investment or account into cash that you could readily take out. And then in addition, I also put, would I get this kind of account? So you can see this is just on my personal opinion, and it might not be right for everyone, but this is what I feel comfortable with right now with the current interest rate environment and where we are in the stock market and with current corporate debt levels. But this could be subject to change depending on where interest rates go and what might be more attractive in the future. So overall, this is what I think about what I would be comfortable with investing right now. And if you enjoyed this video or learned something, please like and subscribe, and let me know in the comments what kinds of assets you're investing in. I'd love to hear from you. Till next time.